Okay, let's dive into the deep and, let's be honest, often really misunderstood world of crypto risk. We are going to peel back the layers on everything, from the absolutely wild price swings to the hidden dangers that are just lurking in the system's architecture. So, where do we even begin? Well, we're going to start with a pretty powerful idea that helps frame the most extreme risks you can find in any market, not just in crypto. And that idea is the black swan event. The term was made famous by Nassim Nicholas Taleb, and he said they have three key traits. First, it's a total outlier, something nobody sees coming. Second, its impact is extreme, often catastrophic. And third, maybe the most human part, is that after it happens, we all invent stories to explain it, making it seem like it was predictable all along. And that brings us to the central question for this whole explainer. With its lightning-fast innovation, its lack of historical data, and all these interconnected systems, you really have to wonder if the crypto world isn't just a lake full of these things. Okay, so let's move on to the most visible risk, right? The one that makes all the headlines, those extreme price swings that for many people basically define the entire crypto experience. To give you an idea of the sheer scale we're talking about, just look at this number. At its peak back in November 2021, the market cap of all crypto assets hit a staggering $2.6 trillion. That is about 3.5 times higher than it was at the start of that same year. Just incredible. Now, what's really fascinating here is how this chart puts that volatility into perspective. Bitcoin's 3-month realized volatility is sitting at a massive 60%. Now, compare that to the S&P 500 at just 16%, or gold at 13%. It's just not even in the same league. It's playing a completely different game. And this timeline, it just perfectly captures that wild ride that investors are on. In less than a single year, Bitcoin more than doubled, peaking up near $68,000, only to lose nearly half its value just a couple of months later. And these moves are driven by everything from pure speculation and news about regulations to, yes, even tweets from celebrities. But here's the thing. If you're only focused on the price of a single asset, you are missing the much bigger picture. The real danger, the one that can threaten the entire ecosystem, is hiding in how the whole system is connected. And this is where we get into something called systemic risk. It's this idea that DeFi protocols, stablecoins, exchanges, they aren't isolated islands. They are so deeply interlinked that a failure in one little corner of the market can spread like a virus, triggering this cascade of failures across the entire board. The 2022 collapse of Terra and Luna is a perfect and, frankly, a brutal case study of this. It all kicked off when UST, which was an algorithmic stablecoin that was supposed to hold a $1 peg using just code, lost that peg. Well, the protocol that was designed to fix this went into overdrive, and it started minting trillions of its sister token, Luna. This sent Luna into a hyperinflationary death spiral that just vaporized $45 billion in market value. Gone. And it did not stop there. That wasn't a one-off. The bankruptcy of the exchange FTX later that same year set off another devastating contagion. It led to the collapse of other huge lenders like Celsius and Voyager. What these events really proved was that even the big, centralized players could be the very first domino to fall. All right, let's peel back another layer now, and this one's a little darker. We're going to look at the underbelly of this ecosystem, the world of illicit finance and the criminals who exploit it. So one of the classic crypto scams is the rug pull. What happens is scammers create a ton of hype around a new token, they convince people to pour their money in, and once the price is pumped up, they drain all the money from the liquidity pool, the asset's value instantly crashes to zero, and they run off with the cash, leaving investors holding worthless tokens. But there's something even more insidious. It's called pig butchering. This is a long con. Criminals, often on dating apps or social media, will build a trusting relationship with the victim over weeks, even months. Once that trust is established, they convince their target to invest in a totally fake crypto platform. And then, poof, they disappear with all the money. So the crucial point here is the sheer scale of the problem. How bad is it? According to the FBI, reported losses from crypto-related scams shot up by nearly 600% in just 1 year, jumping from $246 million to over $1.6 billion. And it is not just about scams that target individuals. The ecosystem is also a battleground for really sophisticated cybercriminals who use crypto for ransomware payments, and even nation-states like North Korea. whose Lazarus Group has been tied to massive crypto heists to fund its weapons programs. So you hear all this, right? The market craziness, the criminal threats, and you have to wonder, what on earth drives people to participate? Well, the answer, as it so often is in finance, comes down to human psychology. And what's really great here is how this shows the emotional seesaw that fuels so much of this market's volatility. On one side, you've got FOMO, the fear of missing out. It pushes people to buy high during a bull run. And on the other side, you've got FUD, fear, uncertainty, and doubt. And that triggers panic selling when the market turns, which just makes the crashes even worse. Now, these emotional responses, they get supercharged by our own built-in behavioral biases. Things like overconfidence or just following the herd, especially when it's all whipped into a frenzy on social media. It leads regular investors to pile into things like meme coins that have no real fundamental value, and often the results are disastrous. And this isn't just theory. This quote from the US Treasury Department really hammers home the real-world financial pain these psychological cycles can cause. It shows just how many people got caught up in the hype and were exploited by scammers. Okay, for our final point, let's zoom all the way out and look at how crypto's relationship with the rest of the financial world has fundamentally changed. For years, the big pitch for crypto was that it was a hedge, right? An uncorrelated asset class that moved independently of the stock market. But that's just not really the case anymore. The data shows that before 2020, the correlation between Bitcoin and the S&P 500 was basically nothing. But since then, that correlation has turned positive and it's getting stronger. So what's the bottom line here? The key takeaway is that crypto is not an isolated island anymore. It is becoming more and more woven into the broader financial system. And that means a crypto crash could make a stock market correction even worse. And a downturn in traditional markets could easily spill over and drag crypto down right along with it. So we've seen it all, right? Volatility that dwarfs traditional markets, systemic collapses that spread like wildfire, a criminal underworld that's both clever and cruel, and a psychological pull that can lead people to ruin. And now, all of this is becoming part of the global financial fabric. So it leaves us with this one big, fascinating question. Is all this risk a fatal flaw? Or is it just a feature? The unavoidable, messy, growing pains of a truly new financial frontier. Understanding this complex anatomy of risk, well, that's the essential first step for anyone who's trying to navigate whatever comes next.